Hungary is about to pay off its debt to the International Monetary Fund and then wants the creditor gone. The country was saved by the Washington-based group with a $25 billion loan 5 years ago, but isn't renewing the aid in order to avoid closer scrutiny of its policies. Alexei Yaroshevsky looks at how Budapest is cutting loose.
This Hungarian family can now enjoy picking a pram for their soon-to-be-born child. When the global recession reached the country, they struggled to repay their mortgage. But thanks to a government support program, their flat now belongs to them, and they've saved at least €10,000.
In that time, we felt that we are in a very critical situation. The government is now quite strong, so what we are seeing, there are lots of steps.
But look at Hungary's economy of late, and you'll be hard-pressed to find much to be optimistic about. The economy is now faring better than during the recession, but still most of the important development figures are in negative territory, while inflation is even higher than in the crisis years. The country's opposition firmly believes Hungary would stagnate without EU aid.
Hungary is a net recipient of EU funds, and this is very important. 97% of all the new developments are today financed from EU money.
However, seeing what's happening in Greece and Spain, Budapest is not keen on grabbing the hands of the international lenders. And in this case, it goes beyond merely the bravado rhetoric often voiced by the country's prime minister. There are literally 30 steps between the building of the National Bank of Hungary and the head office of the International Monetary Fund in Budapest, but that is as close as they get. A letter from one building to another at the end of July said that Hungary no longer required the services of the IMF and that its employees must leave the country as soon as possible. The country's deputy economics minister is tight-lipped on any kind of open hostility towards Brussels, but acknowledges that what the EU bureaucrats are offering does not suit Budapest. His message is we can handle it on our own.
The Greece debt level is, according to GDP, after these two bailouts and restructuring and everything, is 160%. In Hungary, below 80%. The European average is now about 85%. We are able to finance the public debt on the market. You have to introduce the reforms which make the country more competitive. And that is what we have done in the last couple of years. And I think they are the good basis to have an independent economic policy.
Next year, Hungary will host parliamentary elections, and some say the hardline stance with the EU may be part of a political campaign by the right-wing leadership. But analysts are not ruling out that should Viktor Orbán's government be re-elected, the Prime Minister may take his standoff with Brussels to a completely new level, by initiating a referendum on leaving the European Union altogether. Alexei Yaroshevsky, RT, reporting from Budapest in Hungary.